global demand for goods has been slowing down. We're seeing slowing volumes of global trade. Global trade is going to be falling as a share of GDP this year, almost certainly. So it's not perhaps that surprising that we are seeing some weakness in manufacturing economies, industrial production. We've seen this in parts of Asia over the last few months. Only now, as it's starting to stabilize, we're seeing that come through in Germany. So I'm not entirely surprised by this. But of course, politicians, when they're confronted by something which looks weak, say, well, we must do something, and they grab at the first idea that is thrown at them.
Let me just throw in the construction output number, because we've just had that come through as well for March, and that is negative 4.6% on the month. So notwithstanding everything you've just said about the German data and being revised up, the construction output paints another picture of weakness in that economy. How much pressure does this put on the ECB to back off, given this is Europe's largest economy?
Well, the construction data, of course, is slightly different because that is interest rate sensitive. So that is going to be at the front line of the ECB's automatic pilot, don't think, just raise rates approach to policy, which is what they've been doing. So is this going to change the ECB's approach? Well, you'd think, but that would also require the ECB to think and not be on autopilot. And the comments that we've had out from ECB member Knott, for example, are suggesting very much that the autopilot is still intact. What I'm really missing from the ECB is an explanation of what they think they're doing. What is it that the rate hikes are actually going to achieve at an episode of profit-led inflation? They're not really being very constructive on that. And I think this, more than anything else, and perhaps more than any energy plans that come through, this sort of relentless rate hike into a profit-led inflation episode is going to increase divisions within the European economy, which isn't a very good monetary union in the first place. It's not a very well-functioning monetary union. So we're going to see more divisions emerging as a result of this strategy.
What about stateside? And very nice to see you a couple of days ago in Geneva. What about the other side of the Atlantic? The market rallied hard on Friday, the equity market that is, on the basis of, I think, regional banks rally and Apple, but also it didn't see anything it didn't particularly dislike in the payroll, whereas on another day, 250,000 jobs created that might have scared the horses somewhat. What was your reading of that, Paul?
Well, I think the payrolls number, again, a lot of revisions coming through to this. We've got to recognise just how much the quality of payrolls has declined as a statistic. The survey that is used to measure the number of people in employment gets less than a 50% response rate. I mean, over half payrolls is guesswork. So the market is saying, well, things are cooling down. It's not too bad. It's okay. I think there had been concerns, perhaps, that we would be seeing more damage to the consumers from the banking turmoil. Of course, we get the senior loan officers survey out today, which will be quite insightful in that regard. So if they're seeing that the labour market is not faltering, we're not getting a fear of unemployment coming through, then that gives a degree of stability to the consumer spending numbers. They'll still be slowing, but it gives a degree of stability. The great risk, the hard landing scenario for the States, is that people start to panic about job security, increase their precautionary savings, and that would tip the US into a hard landing position.
I'm glad you mentioned the sluice, as the acronym goes, the Senior Loan Officers Opinion Survey, because it's very interesting. We've been told to look at this anyway. We always look at it anyway, but we have to look at it especially because the likes of Yellen and Powell are saying, well, now we think that the crisis in the banking sector might do some of our work for us as well. So it has another meaning for it in terms of not only how much liquidity there is in the market and how much lending is going on, but also whether this tips the scale on rate hikes. Bearing in mind, of course, that there is now a high chance, according to Fed Fund futures, that we're going to see cuts in July, which I find extraordinary, Paul.
Yeah, I think cuts in July is probably traders getting a little bit overexcited. Economists don't get excited in that way. And cuts in July seems to be quite unlikely unless there was some amazing disaster emerging in the financial system, which does not also seem particularly likely. Now, what we're going to remember is bank lending standards were tightening in advance of the Silicon Valley Bank failure. So we're already starting to see a tightening of lending standards, but then the banking turmoil may accelerate that tightening. Now, the thing is that doesn't hit consumers immediate. It will hit consumers, but with a lag. And that's because if you're jogging along with, I don't know, $300 unused limit on your credit card, the tightening of lending standards only hits you when you've burnt through that $300 of additional credit, and you go to your card company or your bank and say, can you extend the limit? And they say no. So there's a lagged effect here, but that would be an issue which would slow consumer spending further. And the Fed does have to take that into account.